Hello, everyone. I'm Matt Clark, research analyst with Money Markets here, and joining me as he does each and every week is Green Zone Fortune's co-editor Charles Sizemore. It is time for Investing with Charles. Now, before we get started, I do want to make sure that if you are not already, subscribe to our YouTube channel. Just click that subscribe button down below, and if you are so inclined, mash that notification bell. You get notified every time we put up a new video, and we do new videos almost every single day. We've got Investing with Charles. We have our marijuana market update, the Bull and Bear podcast. And let's not forget about Ask Adam Anything, where we get to sit down and talk with Chief Investment Strategist Adam O'Dell and ask him any question you want, except for about the painting on his office wall, which we've already covered. It's in Puerto Rico, and there's that. Speaking of being south of the border, Charles Sizemore joining us today from the friendly vistas of Lima, Peru, as he has a couple times over the last several months. He is back in Peru with his family. Charles, welcome. Thanks for joining, and let's dive right into it. Today, we've started off earnings season, and or at least for the latest quarter. And of course, it's always big. Banks always start things off. The financial sector always kicks off earnings. And it's usually a pretty good indicator of what we can expect down the road for the rest of the quarter in terms of earnings. And to say that the financial industry has blown the doors off of earnings in this quarter would probably be a bit of an understatement, because most big banks that have reported thus far have done very well. And today I want to focus on two of them, and I want to compare the two, and finally we'll present our take in terms of which one we think is the better buy for your investment portfolio. But the two I want to talk about, they're big. Everyone knows them. Everyone's heard of them. You may not do business with them, but you do know who they are. The first one is Goldman Sachs. Trades on the New York Stock Exchange. The ticker is GS, and the other one is Morgan Stanley. It also trades on the New York Stock Exchange. Its ticker MS. So MSGS. Take your pick. And I have some charts I'm going to go through and start off with. But one of the things that came to mind here when I started this, Charles, when we were talking about this idea, was I was looking at equity investment revenue. This is where companies that have an arm of their business that focuses strictly on trading.
But before we do that, why don't we back up just a second? Okay. Most people have an idea of what Goldman Sachs does and what Morgan Stanley does. They know that they're, essentially a James Bond villain, stroking a cat. But what do these banks actually do? They are organized as commercial banks, but most of their revenue does not come from lending the same way, Bank of America or Chase or Citi would. These guys are more transactions based in the sense that they serve as a prime broker for hedge funds, for mutual funds, for big institutional investors. Big institutional investors don't go to their E-Trade account or their TD Ameritrade account. They go to a Goldman or a Morgan Stanley to help them execute their trades. They also have investment banking, which means investment bankers are the ones that bring stocks public. So when a stock starts trading on the New York Stock Exchange or NASDAQ, an investment bank basically pushes it along that process and helps it go public. The same with bonds. They'll help them issue bonds and whatnot. Oftentimes they'll also have an in-house wealth management arm, and oftentimes also have an in-house asset management arm. I know those two things kind of sound the same, but they're actually different. Wealth management is basically your financial advisor, right? Whereas asset management is more like running like an internal hedge fund or an internal trading desk or something, mutual fund, whatnot. It's basically trading for your own financial products. Does that make sense? So that's what these guys do. It's quite a bit different than what your Citis and Banks of America and whatnot would do.
Yeah, they don't really issue credit cards. You can't get checks from them. You can't, it's not really like that. These are basically very large financial institutions that act as intermediaries between institutional investors, venture capitalists, things like that, and other in complex business transactions. That's probably a very simplistic way of looking at it. But again, what really stood out to me here, there's a lot of things that stand out here, but both of these companies have equity investment arms, which means they have a team of people that handle investing in equity for third parties, for big institutional investors, for companies, for governments, anything like that.
For the big boys.
Yeah, and they make their money on these trades based on fees that they charge that are typically based on volume. So the more, if Charles and I run a venture capital company and we want to invest $10 million in, ticker ABC, which I'm not, but we would go to a Goldman Sachs.
I'm not even sure there is a ticker ABC, but
I don't think there is.
We're not necessarily recommending it.
Exactly. I don't know it off the top of my head. So, but we would go to a Goldman Sachs or Morgan Stanley and we'd say, we would like to do this. Can you execute this deal for us? And then they will come back and say, yes, we can. We're going to charge you X% of a fee. And that's how they make their revenue on this particular arm. And what stood out here was that for several of the last several quarters here, Morgan Stanley has been basically the leader when it comes to revenue based on their equity trading service. That was until this quarter. Morgan Stanley was actually overtaken by Goldman Sachs. Goldman Sachs reported about, again, these are based on fees, $3.1 billion in fees for Goldman Sachs in equity trading. Morgan Stanley, $2.9 billion. Now, if we take a broader look at quarterly revenue, and I've got a chart here that we'll put up here, and you can see that these two companies move basically in lockstep. There are instances where Goldman Sachs will have a little bit higher quarterly revenue. By and large, Morgan Stanley has had the higher quarterly revenue. That was up until the first of this year when Goldman had a phenomenal first part of the year. Revenue jumped up well past $16 billion for a quarter, but now it is pared back. It's now down to a little below $14 billion. I know the pain, the suffering that they must be going through by only bringing in around $13.8 billion in revenue for a quarter.
The bonus checks are just going to be so Spartan this quarter. It's going to be rough.
It's going to be terrible. Someone's not getting a Maserati this year, and it's just going to be painful for someone. Morgan Stanley, on the other hand, has been relatively flat. They almost touched $16 billion. They have not had a $16 billion revenue quarter yet in their, since 2012, whereas Goldman Sachs has had one. And then now they're flat at around $13 billion in terms of their last couple quarters. But regardless, still very, very good. They move basically in lockstep in terms of their movements. There's some fluctuations here and there, but a lot of them have now relied heavily on their equity trading to produce a bulk of revenue. Because as Charles has said, these companies they're not traditional banks. So they don't make money off deposits. They don't make money off of CDs that they sell. That's not how they generate revenue. They generate revenue by working with large companies in very complex
caveat, they may have an internal bank they own, but that's not a major source of revenue.
That's not
caveat major. It's not that it's not a source, it's not a major source.
Exactly.
It's not the main thing they do.
And so I guess, Charles, give me your thoughts there when you look at just revenue. These are big banks, they make big money. And now we've seen, whereas total revenue, Morgan Stanley has a bit of an edge in this particular sector, this kind of pinpoint sector of equity trading, which has become more and more of a thing for these large banks. Goldman Sachs has started to make a lot of inroads and has taken over Morgan Stanley as the leader in this particular category.
Well, think about the market over the last several years. It's been a raging bull market. So it does make sense that as more people want access to equities, that means you and I are putting our money in funds or whatnot. Those funds are going to Goldman Sachs, Morgan Stanley. They're going to them to execute their trades. So the more we invest, and we collectively, just the investing public, that flows through to a demand for the services of these banks. You and I aren't doing business directly with them, generally speaking, but our interest in equities flows through to them. So that does make sense. Now, interestingly enough, the most volatile part of their business is investment banking. Investment banking is feast or famine. That's, you'll have a wave of IPOs all at once, where fees are, going nuts. And that's when the champagne corks fly. And, that's when these banks really make some money. We have seen, interestingly enough, the IPO market has been hot, but it has sort of been bypassing the banks this go around. It's been focusing more on SPACs and things like that, which are not as, don't get me wrong. The big banks find a way to make money no matter what. These guys are good at anything. It's getting their little fingers into every deal and making a little bit of money, right? But the development of going public via SPAC and things like that, or just not going public at all, just staying private, this has sort of held back their investment banking revenues to some extent, which has forced them to look elsewhere for revenues. It's one of the reasons they've gone heavier into equities and then the institutional market there. So it does make sense.
Now, if we look at, and I'm looking off here at the screen, we'll put these up here. If you look at the stock charts for both of these companies, first off, with both of them have seen significant upward trajectory in the last 12 months. In fact, Goldman Sachs has gained about 104% in their stock price from this time last year. They are trading at about, I want to say 11% above their 50-day moving average, and they are nearly double what the investment services sector average gain is, which is around 61, 62%. Morgan Stanley, on the other hand, will show that. They are up about 103%. So you're only looking at about a 1% difference in terms of and I don't want to compare prices because they are priced much different. So what I'm looking at total return and gain here of their stock price. So you have Morgan Stanley, which is up about 103%. They are trading right at their 50-day moving average. And again, they are up, above the 62% average gain for investment services. So both these stocks, in terms of their movement, are very similar. They have had similar trajectory. You can look at the charts side by side. You can almost put them right on top of each other, and they are almost very, very, very similar in terms of their ups, downs.
And that makes sense. What's good for one is generally good for the other. If macro conditions are good, if investors see a good environment for Goldman, they're generally speaking going to see a good environment for Morgan Stanley as well. So it does make sense that they move together. There are subtle differences in their business compositions, though. For example, Morgan Stanley actually gets a much larger portion of its revenues than Goldman Sachs does from wealth management, just kind of regular financial advisor stuff. That's a bigger piece of their business. Goldman Sachs, their institutional business is a little bit bigger as a percentage of its assets. So that is, but you're talking about differences around the edges, right? As a general rule, both of these guys are in the same lines of work, and their products and services overlap. They do.
Now, the last thing I want to look at is their green zone rating, which anyone can access by going to moneymarkets.com. We've got a little search bar towards the top of the homepage. You just type in any ticker or company you're looking for, and you can pull down our proprietary green zone ratings, which uses 6 different metrics, 3 fundamental, 3 price-based. You've got value, quality, growth, which is on the fundamental side, momentum, size, and volatility, which is on the price side. And those 6 factors come together and make an overall green zone ranking. And it really is a guide that Charles, myself, and Adam, we use on a daily basis when we are looking at stocks. So I definitely encourage you to go to moneymarkets.com and check that out. Now, if we look at these two, again, a lot of similarities here. First off, with Goldman Sachs, they rate an 82 overall. They are particularly strong. They rank very high in both momentum and volatility, because if you remember the stock chart we showed with Goldman Sachs, they've had a very meteoric rise over the last 12 months and is met with very, very little resistance. So momentum begs to understand why the momentum score would be high and the volatility score would be high, suggesting that it has very low volatility. It also rates in the green in value, quality, and growth, which is also kind of to be expected. It ranks very low in size because this is a $142 billion company. And typically, these companies, they're going to rank low in size simply because
it's not like Goldman Sachs or Morgan Stanley are undiscovered small cap gems.
No, these aren't unknown stocks that you just woke up and thought, I'm going to look into that. No, these are companies that have been around for a long time and have built up a lot of capital. In fact, Morgan Stanley is actually bigger by market cap. Its market cap is around 186 billion. It ranks 75 on our green zone rating model, and which means we're bullish on both. The score suggests we're a little stronger bullish on Goldman Sachs than we are on Morgan Stanley. We'll touch into that here in just a second. But actually, Morgan Stanley ranks higher in momentum. It ranks a 94 in momentum, whereas Goldman Sachs is only an 89. Again, it's a marginal difference. It's not really a huge difference, a huge variance, but a slight difference could suggest that momentum could be a little bit more in the offing for Morgan Stanley than for Goldman Sachs. But a 5-point difference isn't necessarily going to make or break.
No, I mean, like with the green zone scale, if the stock rate's a 98 or a 99, we don't necessarily think the 99 is going to massively outperform the 98.
Exactly.
Once they're rated bullish or strong bullish, there's a decent bit of wiggle room in there, and these ratings can even fluctuate a little bit from day to day. So we consider this, a broadsword, not a surgical scalpel.
Exactly, but it is a good tool. Again, moneymarkets.com. You just type in your ticker, your company, your search bar, and boom, like that, you pull it up. So now, looking at that, we've looked at quarterly revenue. We've discussed business operations. We've looked at the stock charts for both, and now we've examined the green zone rankings for both. Charles, gun to your head, you've got to buy one or the other. Which are you going with, and why?
Gun in my head, I'm going to go with the original vampire squid. I'm going to go with Goldman Sachs. And the reason is I do like their product mix a little bit better. I like that wealth management is a smaller part of their total. I look at wealth management, and I see a really tough business. Fee compression is a deal. Competition is brutal. And at the end of the day, you're competing over relatively small accounts that aren't that profitable. So I think that their Goldman's bigger percentage of revenues, based on institutional business. I think that's the way to go.
And I'm going to agree with you. I know last time we talked, we compared stocks and we didn't agree. This time I do agree. Even though we have a fluctuation in the momentum scoring. In terms of value, both are very good. I think Goldman is the better value. I think it's trading at PE ratios, price to book, price to sales, and their ratios are a little bit better, suggesting a little bit better value of a buy at this point. I think quality-wise, I would give Goldman an edge here too. I think its return-ons are a bit stronger. Their returns on investment equity and assets are a bit stronger than Morgan Stanley. Again, let me preface all this by saying that we're not suggesting either one of these companies are bad. It's just if we have to pick one, we're going to go with Goldman. Also,
it's close. So if Goldman does well, it's highly likely Morgan Stanley does well. It'd be very unusual for one to do well and the other to do poorly. But if you got to pick one, I think we're in agreement. Goldman's the better buy here.
Absolutely. Goldman is the way to go. That is our recommendation. So if you are looking at a big bank, if you are looking at a big investment institution that you want to add to your portfolio, we're telling you, I think Goldman Sachs is the way to go. Again, check out our green zone rating system. You can do that at moneymarkets.com. Just go to the top search bar and you can type in your ticker and you can pull up any of the stocks that we rate. You will be able to find exactly how we rate them, what their ratings are in each one of the metrics. You can get a stock chart, a definition of what the company does, and even some of its fundamental information. And all that is on moneyandmarkets.com. Charles, it's been a pleasure. Certainly enjoyed being back in the saddle with you. I know we had a bit of an off week last week, but I think we're back in it to win it this time around. Enjoy Peru. You go there all the time, so it's not like you're going to find anything new, I don't think, but enjoy it.
I am going to eat me some lomo saltado for lunch. If you are unfamiliar, it is delicious.
I'm very jealous at this point of that for you. So again, check out all of our YouTube videos. We've got a ton out there. Ask Adam Anything, Investing with Charles, Marijuana Market Update, The Bull and the Bear. We have a ton, so make sure you check it out. Subscribe, hit that subscribe button, mash that notification bell, get notified each and every time we put out a new video. Also, submit a question. If you have a question for myself, Charles, or Adam, you can do that. You can email us at feedback@moneyandmarkets.com. We'll flash that down below, or you can even comment down below here on our YouTube channel. And if we use your question, we are going to get you in touch with the rest of our team to send you some very cool Money and Markets gear. Could be hat, could be sweatshirts, could be t-shirts, could be a wide range of things. We finally got the boss off of his duff to do some work and order us some swag so that we can get out to all of our loyal followers and viewers. So make sure you do that. Feedback@moneymarkets.com or comment down below on YouTube. Charles, thanks so much. We're going to do it again next week. Until next time, everyone, I am research analyst Matt Clark. Safe trading, everyone.